8:30, so I'll go ahead and call the meeting to order. For those who don't know me, I'm Bruce Messelt, and I serve as the administrator for Sherburne County. Dan is actually on WebEx, so he's smiling and waving here, and he's gonna correct some. There you are. Come on, Dan. Felix is waving, so so Dan's gonna help facilitate the meeting, and obviously we'll be back at the next meeting, but. And then Tim Sy may also be joining us remotely for any type of legal stuff we need. If not, Kathy's on standby on phone call as well, but hopefully we won't require it. And I apologize for the confusion, as Chrissy and I were batting cleanup here this week. We sent out an email with the link, and it was intended for the staff people. So we haven't set up for you all to do remote meetings, and so sorry for the confusion on that. By means of roll call, we can just go around and do introductions, but in doing so, I want to recognize our new committee member. So, Greta, I'm going to ask you if you'll introduce yourself, and then we'll go around the room and everybody can introduce themselves, and then Chrissy will take the roll that way. Is that okay? Sure. All right. And if you would speak up just a little bit, because Dan's hard of hearing as well. So, sorry, Dan.
Microphones right above.
Microphones, yeah. So.
Good morning, everyone. I'm Greta Stark-Crocker. I'm a longtime Sherburne County resident. Most of my life, I live up by Clear Lake, and I have an interest in community government and learning more and joining this board. And professionally, I'm executive director of the Central Minnesota Community Foundation. I'm happy to be here.
Good morning. I'm Molly Hansen. I'm the executive director with the YMCA right next door, and also oversee the Y of the North sports programs, and my second year here.
Andy Voller from Becker, Chief Operating Officer at American Heritage National Bank up in St. Cloud. And this is my second year here.
Good morning, everyone. I'm Kevin Weirs. I'm Vice President of the Central Minnesota Development Company. We're a private nonprofit that facilitates business financing, and we're a facilitator with the Sherburne County revolving loan fund that we'll be talking about today. So,
I'm Ken Giroux.
I'm Laura Kangas with Arvig. I live in Clear Lake as well, Palmer Township, and I've been a Sherburne County resident for 30 years as well.
Jared Johnson, I'm the GM of the Cargill facility in Big Lake, and I think I've been here now for, I don't even know, Dan, 6 years, 5 years, somewhere around there?
I think you're muted, Dan. You might have to unmute.
You're 6, Jared. You're correct.
Okay.
Felix Schmiesing, County Board, District 4.
Tim Nolan, County Board, District 3, right next door.
And I actually, Felix has been around so long, I didn't think that you're technically a new member too. So coming on the board, coming on as a commissioner appointed to the EDA as well. And
I'll try to get it right this time.
Yeah.
Okay.
Well, if it's a 6-year tour, we got you for a while. So. Okay, well, welcome everybody. The first order of business, and then hopefully I can turn this over, but I'll facilitate as needed, is to elect officers. So this is kind of the annual organizational meeting, so we go through a bunch of things and then really just have one order of business for today. So the first thing is to elect an EDA chair. Just for note, Tim Dolan served as the chair last year for 2021, but anybody is eligible to serve as chair. With that, I would ask for any nominations for anybody to serve as chair.
I'll nominate Ken Giroux as EDA chair.
Okay. Is there any other nominations? Are there any other nominations?
Ask one more time.
Are there any other nominations? All right. Seeing none, we'll close nominations for chair, and I would ask for unanimous consent to have Ken elected as chair, signified by saying aye.
Aye.
Any opposed? Same sign, nay. None. Welcome, Mr. Chair. Do you want to take over the meeting, or do you want me to run through the administrative
you're
pieces?
rolling well.
I'm rolling well. All right. All right. So the second order of business is to elect a vice chair. Last year, Ken served as vice chair, so this is a succession plan in the making. Are there nominations for anybody to serve as vice chair? Any nominations for vice chair?
I'd nominate Andy Bowler.
Okay, nomination, Andy?
Andy.
Thank you. Andy Wooler. Is there any other nominations? Any other nominations? Any other nominations? Seeing none, we'll signify by unanimous ballot. Again, approval by aye with Andy being serving as vice chair. All those in favor, please say aye.
Aye.
Anyone opposed? Okay, congratulations. All right, secretary. So Laura served as secretary last year. Rumor has it that that's a good thing to continue doing, but we don't want to poison the ballot. So are there nominations for secretary for 2022?
I'll nominate Laura.
Woo! All right. Any other nominations? Any other nominations? Any other nominations? Seeing none, we'll close nominations. All those in favor of Laura continuing on the secretary, please say aye.
Aye.
Anyone opposed? All right, congratulations. Now you can sign all those documents again, so. And last is treasurer. So last year Jared served. Are there nominations?
I'll nominate Sheldon Poole. He is unable to be here today, but did offer up his services, so.
And I'm sorry, Tom was last year, so Sheldon,
Sheldon Poole.
okay, cool, all right. Are there any other nominations? Any other nominations? Any other nominations? Okay, seeing none, all those in favor of Sheldon Poole serving as treasurer, please signify by saying aye.
Aye.
Anybody opposed? Okay. Last is Eda Assistant Treasurer, and that was Jared. My apologies. I just elevated you already. Any nominations to continue in that role or have somebody else serve?
I'll nominate Jared to keep serving if he's all right with that title.
All right. Anybody want a second? We don't. Not doing seconds. Any other nominations? Excuse me. Any other nominations? Any other nominations? Seeing none, all those in favor of Jared serving, please say aye.
Aye.
Anybody opposed? Thanks, Jared. Before we move on that note, I did want to take a second to recognize Tom and his passing. And just, you know, he served this community exceptionally well. He served this organization. I didn't know him super well. Felix, I think you knew him quite well. But it will be a loss to our community. You want to say anything?
Tom passed away Saturday afternoon. He had fought a long battle with cancer, had been to Mayo a couple of times, and it had been a struggle. So, and he had not been well the last few months. So, but Tom was a great member of the community and a really good businessman, farmer. It's hard to find anyone that said anything about having bad dealings with Tom. He was really good guy, and he will be missed in this community. Thank you.
And I thank you for sharing too. All right, moving on to item number 5, the election of the executive director. This is a very competitive race this year, so I will open up nominations for executive director of the EDA.
I'll nominate Dan Weber.
All right, there's a nomination for Dan Weber to serve as the executive director. Are there any other nominations? Any other nominations? Any other nominations? Seeing none, we'll close nominations. All those in favor of Dan continuing to serve as the best executive director in the state of Minnesota, please signify by saying aye.
Aye.
Anybody opposed? Thank you. Dan, congratulations.
Thank you.
All right. Do you have your nomination speech ready?
I just said it, thank you.
Less is more, right? I should learn from you. All right, approval of the, I guess we didn't formally approve the agenda, so we should, we'll do the meeting agenda for the rest of the meeting. Mr. Chair, is that okay if we ask for approval of the agenda?
Absolutely.
Okay, is there a motion to approve the agenda? Make a motion to approve the agenda. Thank you. Is there a second?
Second.
Second. Any discussion? Seeing none, I'll signify by saying aye.
Aye.
Anybody opposed? Agenda is approved. Next is the minutes from the meeting of November 18th, 2021, which were sent out for your review. Is there a motion to approve the minutes?
We'll do it. I'll move approval of the minutes as presented.
Okay, minutes as presented. Is there a second?
I'll second.
Is there discussion, changes, corrections? stimulating reading, so. Thanks, Laura. All right, seeing no discussion, we'll move the question. All those in favor of approving the minutes, please signify by saying aye.
Aye.
Any opposed? Thank you. Next item, number 8, is the official newspaper of the Economic Development Authority. Recommended is the Elk River Star, which would match the 2022 County Board official newspaper. Is there a motion to approve the official newspaper as the Elk River Star?
So moved.
Is there a second?
Second.
Is there any discussion? Okay, motions, Andy seconded. Seeing no discussion, all those in favor, please signify by saying aye.
Aye.
Any opposed? Motion approved. Next is to approve the official depository of the EDA, which is the Bank of Elk River, which will also match the county board's official depository. The recommendation from staff, is there a motion to approve?
I'll make a motion to approve the Bank of Elk River be the main banking official.
Thank you. Is there a second?
Second.
Is there any discussion? Seeing no discussion, all those in favor, please signify by saying aye.
Aye.
Any opposed? Approved. Thank you. Place of meeting designation during the calendar year. The recommendation is that we continue to meet in this Sherburne County boardroom. Is there a motion to approve?
I'll make the motion to approve.
Is there a second?
Second.
Any discussion? Seeing none, all signify by saying aye.
Aye.
Any opposed? Thank you. 2 more great, exciting items of business, and then Ken's going to take over and have at least a better discussion than I am. So, determination of the 22 meeting dates, and you see the proposed meeting calendar in your packet. I'll let you look it over first if you didn't get a chance, and then see if there's a motion to approve.
I'll make the motion to approve the.
Is there a second?
I'll second Laura.
Second. Okay, taking a look at it, any discussion, any thoughts or calendar conflicts that you can see?
I just add that it's at 8:30 again as a suggested time, that we keep it at 8:30.
So we'll add that as part of the agenda, so these would be 8:30. Okay. Motion and second are okay with a friendly amendment that it says 8:30 on those dates?
Yes.
Okay. Any other discussion? Okay, seeing none, all those in favor, please signify by saying aye.
Aye.
Any opposed? Wonderful. And last is a discussion of bylaw or enabling resolution changes, and we don't have any, is that correct, Dan?
Correct, none this year.
Okay. Is there anything that you, as members, have seen that we should start thinking about and considering for the next year? Anything that's come to your mind?
So last year was a heavy lift, so after that, I think nothing on top of my mind.
Yeah, I think if you get a chance and you know, over the year, if you see something and it's like, hey, this isn't working or we can do this better, if you would just flag it, then Dan can start working on it and take a look at it. But yeah, there were good changes made, and it seems like it's really functioning super well, so. Okay, with that, we will go to item 13, which is revolving loan fund application for Engaged Technology. At this point, Mr. Chair, if you're okay, we could have a short presentation before discussion.
Absolutely.
Okay, Kevin, do you want to fire off?
Certainly. Dan, has everybody seen the PowerPoint presentation? Okay. So, yeah, I'll
Kevin, if you want, I think we can pull it up, can't we, Chrissy? So she'll pull it up for you too, so.
Yeah, it was included in your packet, and Kevin will go over everything, so
Got it.
in order to avoid duplication, I'll just turn it over to Kevin
Yeah,
right now.
okay. Well, again, good morning, everyone. My name's Kevin Weirs, Vice President of Central Minnesota Development Company, and for our new member, I just want to take a moment to share who I am and our role in this process. CMDC is an underwriter, has an underwriting role with the county to analyze the risk and the likelihood of either a payment default or a risk of loss for their revolving loans that are presented to them. And so our role in that, in this process, is to underwrite on behalf of the county and to present our findings. What we typically do is prepare a fairly in-depth presentation and what lenders refer to as a credit memorandum. And that is our report that gets generated and provided to particularly Mr. Weber in this process for his review. And then what I do is come in and summarize our findings in that and with that, make a recommendation for either an approval or a denial based off our findings. So that's our role in this process. And as lenders, we typically are, and I'm going to keep this from just a general high-level overview without getting into overly specifics at this particular meeting. All the specifics are found in that credit memorandum. But as a lender, we like to talk about the 5 C's of credit. And so I'll summarize those in our meeting today on our findings on that. So typically, the first C of that 5 C's of credit is the conditions, and that is discuss the financing project. Let me first go off, since we're got this up, let me see if I can.
I think that's the right button.
It's the right button? Okay. So again, let me go back. This is a project to assist Engage Technologies Corporation. This is a very seasoned business that has currently 3 locations, one being in Rogers, another one, let me see where the other locations are at here. They've got locations in Brooklyn Park, Spring Lake Park, and Rogers. And the company has seen substantial growth over the last number of years. And Engage Technologies Corporation has various subsidiaries within that overall holding company. And one of them is this Eda Enterprises, and a second one is American Film and Machinery. These are product lines that are included in the overall holdings of Engage Technology Corporation. What we're looking at today is an opportunity that has already taken place. This is a little bit unusual because the business already purchased and closed on the property in the middle of December. And they needed to do that for various reasons. As some of you are aware, there's various tax reasons for buyers and sellers to close by year end. And there was other motivations as a result of the seller having some issues to resolve and shore up that was imperative to happen by the end of the year too. So this project, unlike most projects, already closed and was funded at that point. But we are here to, in essence, review a request for reimbursement of part of the equity injection that the company, Engage Technologies, had to do in order to make this transaction happen by the end of the year. But these particular companies, Eda Enterprises and American Film Machinery, are located in their Rogers location. So that's where they're currently housed out of. Because of that, the company's substantial growth, they've outgrown that facility and saw an opportunity to take advantage of that new location up in Big Lake in the industrial park, that the building that they purchased. So what they're doing is moving those business lines into Big Lake, which I'll move this along. You can see right there is a copy of the plat and an exterior picture of the building itself. Very nice building. It's roughly 48,000 square feet in size. The address is 20055 177th Street in Northwest in Big Lake. Some of you might know the previous owner of that was Rural Airflow, I believe, is the previous business that occupied that. And so this new business, Engage Technologies Corporation, is going to replace that operating company up there. Project details, again, as I already alluded to, it's slightly over 48,000 square feet. The majority of it consists of warehouse space, but roughly 8,000 square feet of office space as well. So, in addition to that, there was some delinquent taxes previously on that property that, as a result of this transaction brought everything current from a property tax standpoint. So certainly from a county standpoint, that was an incentive to make this project work as well. So you can see kind of an outline of a summary of what the businesses do. They're a manufacturer, primarily in packaging and packaging equipment. And again, they've got two particular business lines that are going to operate out of the Big Lake facility. 38 jobs is what they're going to have at that location. And it appears as though they're going to have roughly 7 new jobs that they're going to create by this expansion and this additional capacity over the next couple years. So the request that we have here is a $100,000 loan set up for 25 years. The additional financing structure includes basically 80% coming from Northeast Bank. That's a $2 million loan that Northeast Bank did on a conventional basis. And then the business owner did provide, ultimately, they provided the full $500,000 of the required equity injection. The purchase price was $2.5 million. So the bank provided $2 million, and then there was equity of $500,000 that was initially injected into the project. And the revolving loan fund will reimburse the owner, who's David Myria, of that. And he was able to temporarily fund that, but as some of you may know, me being business owners, cash flow and cash is particularly critical on a growing company. And even though he was able to find the resources to bridge that gap entirely, he needs that additional money to support the company's growth with this additional $100,000 of equity that we replenish as working capital. Summarizing kind of the loan strengths, this is a very seasoned business. Again, the business is primarily owned by David Malloria. He's a 65% owner of the company. As is often the case, there will be and has been a real estate holding company formed that actually purchased the property. That particular company is owned 100% by Mr. Malloria as well. And then it subsequently leases the entire building to the operating company. And in this particular case, our operating company is again in Engage Technologies. So that structure is very common. So the borrowing entity will be this Arcadia investment, the company that David has formed. That will be the borrowing entity. However, Mr. Malloria and the company, Engage Technology, the corporation, will also be guarantors of the loan too. In addition to that, from a collateral standpoint, there'll be a second lien position mortgage placed on the property that will secure the $100,000 that the county will potentially do if you approve this loan. Let me go back to that. So I want to touch about the collateral. Even though I'm not a huge advocate on stressing collateral, because as a junior lien position, being in a subordinate lien position is always a little bit challenging, and collateral, albeit required and looked upon, isn't necessarily the biggest strength of looking at a source of repayment. But in this particular deal, we do have some equity in there. That the purchase price was $2.5 million, but an appraisal was done on it, and it actually came in at $2,770,000. So there's this additional equity of $270,000 that is up and above what the company purchased the property for. So in light of that, you have a total loan to value position based off $2.1 million that we would have ultimately on this deal, with a property that's valued at $2,770,000. So there is a reasonable amount of equity into that property. Again, David Myroya is the majority owner, has excellent personal credit history, as well as personal discretionary income. Just a side note, Mr. Malloria is also an attorney. In fact, that's how he got involved in the ownership and the operations of this business. He was, prior to being an owner of the business, was the company's counsel. He was the attorney for them. And as a result of the passing of one of the original founder and owner of the business, and through kind of the estate planning, Mr. Malaria stepped in and purchased a number of years ago the majority of that operating company. So again, very strong personal credit as well as very significant personal discretionary income from Mr. Malaria, if needed, to support the loan if there were to be any challenges with that. Also on this particular project, as there is always in every case, there's a conventional and private lender involved in this. And the lending partner on this project is Northeast Bank. And so Northeast Bank, again, has been banking this particular business for a number of years and speaks very highly of the operations and the management of this company. So they have covenants in place. And for those of you that don't have the experience, covenants are kind of conditions that need to be met and kind of monitoring of performance that they look at after a loan is originated. They will work with and monitor the performance, particularly the financial performance of that business, to make sure that they're in compliance and that if there's any concerns recognized, they're recognized early within a process. So Northeast Bank does have some covenants in place to provide some assurance that kind of the historical operations and the expected performance, particularly as it relates to cash flow, and as lenders, we're always focused on cash flow, that those performance covenants are met. And if they're not, or if there's some concerns, the bank has the ability to go in and require the operations to either make adjustments to their either operations or disbursements or cash distribution. So it's always assuring that we have a bank that's monitoring them through covenants. On the risk side of it, in my analysis, the primary risk focused on a couple of the loans that the company has, and particularly they focused on loans that were associated with the buyout, Mr. Malaria's buyout of the shares of the estate that held the company's stocks ownerships at that point. This is a company that had substantial net worth and worth to it. So the buyout of that was fairly significant, and that was primarily financed through two loans, one at Northeast Bank, which again is our lender in financing the real estate. So that's reassuring because they're monitoring not only the buyout loan, but this real estate loan. But then there was another loan with the estate, this trust of the former owner that passed away. Those are fairly aggressive loans, payouts, and so they're fairly substantial in monthly payments. And that probably, well, they are having the biggest effect on monthly cash flow. Cash flow is still positive, otherwise we wouldn't be talking here. We'd certainly need to make sure that there's sufficient cash flow to support the debt service, but they're fairly substantial. But that is mitigated, again, by this fact that the Northeast Bank does have these covenants in place. In fact, they have covenants that if their debt service coverage ratio of 1.25 is not met, then they can step in and require that those loans particularly to that trust, are put on standby. So that does create some flexibility that if cash becomes somewhat challenging, that the bank can step in and adjust those and allow the company some breathing room from a cash flow standpoint. So that's a very positive. So that risk is mitigated by those covenants in there. And of course, the other risk to that is an unexpected death of David Malaria. However, as we often do in particular cases like this, when we have somebody that's key to the operation, we make a recommendation that there's a collateral assignment of life insurance on that particular individual pledged to support that in an event of an unexpected death. And that's our recommendation in this particular project as well as that David Malrelli will provide a collateral assignment of life insurance in the amount of $100,000. So, again, based off my analysis and our company's analysis, we certainly believe that this is a company that has done an excellent job, experiencing tremendous growth, and is a perfect candidate for the program. So our recommendation is to approve as presented.
Mr. Chair, I'd just say, if I could ask a question, please. Now, there's a holding company that will hold this real estate. What all is in that? Do you know? Is that part of the real estate holdings that they already have for their other sites? And if they're moving here, will some of those be liquidated? And that's probably questions you can't answer, or
Yep,
maybe can't ask, I don't know.
Yep. So these other locations that the companies have, as is often the case, is that separate real estate holding companies, I call them eligible passive companies, are typically formed to strictly own that particular asset. That is primarily done for tax purposes and liability reasons. So each of those separate locations that the company has are owned by separate LLCs, and that is the case. So this newly formed company was just created for the sole purpose of purchasing and owning that particular asset, which then will subsequently lease that space to the operating company. So,
Who's got this?
Your call, boss.
All right,
I think if you're willing, probably ask Dan for his recommendation as well as your
sure.
past and now current executive directors.
Well, I'd like to thank Kevin for his very thorough analysis and presentation, always very helpful. So I'd open it up for discussion. Dan, that includes you.
I just wanted to add that there are 6 outstanding revolving loan funds that was on that last slide, and we do have a balance of about $250,000 right now. So there is sufficient funds to award this loan if approved.
Thank you.
Mr. Chair, just to speak, I think it's important that we kind of look at this and its unorthodox components of coming after closing. And I do know that the company was in conversations with the city of Big Lake and with Dan prior to the closing, and due to some unique circumstances, especially the back taxes and potential tax forfeiture of the property, they had to move quick. So they do have that closed, but they haven't moved the company yet. So I think, we were able to tell them that they fit the parameters of this program prior to them closing. We obviously can't tell them that it will be approved, but we told them that, where they fit within all of the guidelines and everything like that. So as unorthodox as it is, I like the project, and I think it's continues on with our history of partnering with these companies and a strong likelihood of repayment, and even possibly early repayment on this, like we've seen recently.
And on that note, Mr. Stein's not here, but he would have echoed that. His legal opinion is it meets the criteria. However, the EDA does have the authority and the discretion to approve or not approve. But our criteria as they stand, it's met. And as Tim said, the lineup of, they were able to buy it without this does raise at least a question. But if it's sufficiently answered, you have the discretion to move forward with this.
Good. Any other discussion before we go to a vote? I'd echo what Tim said. I think it's a great project. I think it's a intended use of the program. I have no concerns about the timing of this. Those are just real world issues that happen in business all the time. So I think those are clarified, and I understand completely why it was done that way. So I think it's a great project on my end. So with that, I'd entertain a motion to approve.
I'll make the motion to approve.
All right, we have a motion. Do I have a second?
I'll second.
Second. All in favor?
Aye.
Opposed? Motion carries. Job well done, Kevin. All right, that brings us to a tax abatement financing policy basics. Ms. Jessica Green is gonna entertain us for a while.
Jessica, I'm gonna give you
Crocker, real quick. Well, good morning, everyone. I'm Jessica Green with Northland Security. Thank you. I think this is likely the first time that Northland's been in front of the EDA board, so just a very quick introduction. So Northland serves as financial advisor to the county. We've worked on some bonding projects together. We've done some financial planning for the county, and then we get called in from time to time when some development projects come in that need a TIF run or talking about abatement, et cetera. But the purpose of today's discussion is to focus on the Tax Abatement Authority. We were in, I think it's in November. I'm losing track of the years, let alone the months at this point. But we came in and we met with the board at their workshop, I believe in November, to talk about the Tax Abatement Authority, kind of how things work, et cetera, and then go over some sort of policy discussion. So my understanding is that the board liked the information so much that you invited us to come back and talk with the EDA. So we've got this presentation today,
And again, I'm going to interrupt Jessica for just a second, Mr. Chair. So you guys know that we had taken a look at our tax abatement and TIF policy, and it's kind of in discussion right now. And prior to Rayanne leaving the EDA through our rotation on the board, she had requested, she thought it would be valuable for everybody in this room to get the same presentation that our board got, so everybody has a little bit more background on how those function, and can give a little bit more informed insight into the policies that we have. It's kind of how that went. So,
And if I can just add to that, Tim, I think part of the reason that the board wanted to be, to talk about this was we've had some long durations on them. And that was something that we wanted to look at and talk about and think about how long do we want to be going. Right?
perfect.
Okay, so today we're going to spend a little bit of time up front just talking about the Tax Abatement Authority, how things work. We'll go over some just general pros and cons, and then go into some policy comparison. We're going to keep things pretty high level today, but if there are any situations or questions where you want to sort of get down into the weeds, just let me know and we can dive into that. Okay, so tax abatement is authorized under statute 469. We've got the specific chapters that are referenced there, and then of course we've got a link in case you really do want to get into the detail of that specific statute. But the power to provide abatement is given to cities, towns, school districts, and counties, not given to EDAs or HRAs. But that being said, when we do see cities or counties that have active EDAs, it's not uncommon to see those applications go before the EDA first. And perhaps the EDA is providing a recommendation to the governing board whether or not they would recommend approval of tax abatement. So while the power does not rest with the EDA or the HRA, certainly not uncommon to see the EDA involved in the conversation. So one of the things we kind of like to clear up right away is any sort of misnomer about abatement. The term abatement can be misleading, and it's somewhat complicated by the fact that in Minnesota, the way that tax abatement works, people tend to think, okay, you're reducing or you're eliminating taxes. And that is actually not how it works here in Minnesota. It does work that way in certain other states, so again, that adds to the complication. But when we talk about things like abating nuisances, for example, you're making those things go away. In Minnesota, all property taxes are owed by the property owner. So as new development occurs and that tax base increase, that tax bill increases as well. So that property owner continues to make those payments. Now, if you've entered into an abatement agreement or a development agreement to provide abatement to support a project, typically what happens is the property owner is making the payment on an annual basis or semi-annual basis, and then the property owner is getting some type of reimbursement back from the county or the city, whoever has agreed to that abatement. The way that that money is collected for that reimbursement is through an abatement levy. So typically what we see in most cases of abatement is that you're seeing, again, that property tax increase, but you're also seeing that additional levy. So those things tend to cancel out. And I would say 95% of the time it's a neutral position, and we'll talk a little bit more about that in just a moment. But generally speaking, when we're using tax abatement, it's typically for development type projects or projects that we'd see purposes similar to tax increment financing. So when you're seeing those applications, first you want to take a look at whether or not you can make the findings to support the use of tax abatement. Now, I think everyone's likely familiar with the term but-for test when it comes to tax increment financing, which means but for the assistance, the project would not move forward. When it comes to abatement, those findings are going to be much less detailed, very few requirements when it comes to the state authority. However, there are two pieces that you want to pay attention to. That one, the expected benefits of providing that abatement for that project at least equal or exceed the cost of providing the abatement, and then is it within the public interest? Now, there's no specific statutory criteria for the benefits and cost piece of things, but typically you see cities or counties sort of relying on that there's an increase in jobs, that you're going to see an increase in the tax base, et cetera. You may see other businesses locating in that area because of that particular development, or other goods and services coming into the community. Whatever those potential benefits are and how they've been sort of, those findings are determined by the board. You just want to make sure that those are in that approving resolution. For the public interest piece of the puzzle, there are 8 areas that are identified in statute, and they're what you would think they would be here. So you're looking at, again, increase in tax base, increase in jobs, you could support public facilities, redevelopment activities, et cetera. So same thing as with the benefit, you just want to make sure that those are listed in the resolution that approves the abatement. So why do cities, counties, et cetera, choose to use abatement? Abatement is a very, very flexible tool. If you've ever worked through the TIF process, I'm sure that you've seen that those findings can be difficult or a challenge to meet. Redevelopment projects, for example, they need to be on parcels that contain buildings that can be found to be substandard by building code. They need to be reasonably distributed amongst the parcels that are within the district. So if you're not able to meet that, but you still have a project where you want to see redevelopment occur, abatement may be a good option. For housing districts with TIF, you've got to have an affordability component. But perhaps someone's approaching the county and they have a market rate project that and the county is supportive of that. You could use abatement rather than going the TIF route. And then for economic development projects, typically we see, warehousing and distribution, manufacturing, those industrial uses. But with abatement, you don't need to be concerned about that. There's no sort of eligible activity that's occurring. You've got a retail shop that you want to support with abatement, you can do that. Shoot. Okay. So a couple of things here that you want to keep in mind when thinking about whether or not to grant abatement, and I'll preface this by saying this is typically not an issue for a county, where your tax capacity is much larger than, say, a city or a town, or even the school district for that matter. But you do want to make sure that the combined total of abatements that are granted on an annual basis don't exceed 10% of your net tax capacity. There is a stipulation in statute that you can go up to 200,000, whichever is greater, the 10% or 200,000. This really comes into play with smaller cities where we do see them bumping up against that 10% limitation. Then they'll rely on that 200,000 because it gives them a little more room. So calculating the tax abatement levy. So first, you're going to identify the parcels that are within the abatement area, and that's typically where that development is occurring. And then you're going to look at what that increase in value is. From there, you take that taxable market value, and that gets calculated into the tax capacity associated with that particular project. You multiply that by the jurisdiction's tax rate, and that's what gets you the annual abatement levy. So again, as we talked about before, you see that value come up, you add that levy to the overall levy of the county, and they typically would cancel each other out. So this is an example of a city project that we worked on. So in that middle column, what you'll see is, in this particular case, the general levies for that city were the $858,750. They, in this example, first without having any abatement levies or approved abatements. So that means that their total levies there are going to remain at that $858. Down below, what you'll see is that tax capacity goes to 1,091,623. They take some off for the TIF that they've got approved, and that means that they have a net tax capacity of that 1,087,000. With that, their tax rate, so it's the net tax capacity combined with that total certified levy, what you've got there is a total city tax rate of that 79%. So the following column, what you'll see is that we've introduced an abatement levy here. So the city's general levy stays the exact same. The tax abatement levy is introduced at 35,000 and some change. That means that their total certified levies have gone up to that 894. Now, the thing to pay attention to is at the bottom. So you'll see that the tax capacity and the net tax capacity, we haven't changed anything with the TIF, have both gone up. So, and that is a result of that particular project. So, sort of the lesson here is that that net tax capacity, that new tax capacity based on that development, combined with that new certified levy, that tax rate is exactly the same. And what that means, sometimes you'll get concerned citizens, et cetera, that will say, well, my taxes are going to go up because you're supporting this project, because you're eliminating their taxes, which we know that that is not the case. But all things held constant, if my home is valued at $200,000 this year, and it's again valued at $200,000 next year, if nothing else has changed, if those general levies that the county is going to certify haven't changed, and the only thing that's been introduced is that abatement levy, plus you've got that new development, my taxes have not changed at all because that tax rate remains flat. The only time that you would see pressure on the actual levy is if you're abating the base value that exists today. And it just doesn't happen very often. Statute does allow for that, different than TIF where the base value is locked as of today. But most jurisdictions, when they are considering abatement, they're gonna look at it that way. Okay, this base value exists today. There's no reason for us to abate that. We're gonna abate on that new value. So anyways, before we move on from there, does anybody have questions about how that tax rate works, how the levy works?
We're expecting you all to be taxing experts after this, so we have to answer less questions.
Jessica, would it be possible to send this to us somehow?
Yeah, absolutely.
Kind of digest it a little bit more?
Yeah, and just generally speaking, the property tax system in Minnesota is much more complicated than it is in other states. So I think there's, some of this is just designed to be confusing, at least it feels that way sometimes, especially when it comes to things like TIF and abatement. But same thing when we talk about TIF, again, the impact for me personally should be zero. Again, you have to think about it in terms of things remaining equal and nothing else changing, which it's impossible to kind of think of it that way because levies are always going to change. Tax values for your homes are always going to change, but it's not the impact of that particular development. You're only abating on that new value.
If you hear anything on tax abatements, that's what it would be, is that it is being balanced on the shoulders of other taxpayers.
Correct.
This clarifies that, see.
Okay, so benefits of using tax abatement. So it's like with any development, you're looking for new jobs being created, new housing coming into the community. And then with those things, you're hoping to see additional traffic in the community, additional revenue sort of circulated. If you've got a new manufacturing facility, you're hoping that those people coming into town are using the gas stations or having lunch in town, et cetera. And then, of course, you're hoping that there's some additional development that is spurred because of that. And we know that additional rooftops or additional industry always, not always, but tends to lead to additional development happening. So it's not just that development that you want to think about, it's the sort of other impacts that may come over time. I am not doing well with this today.
You're far enough away, it's
Sticky clicker.
Not going to touch it. All right, negatives of tax abatement. So this word is important. Foregoing of tax revenue from development for a specific period of time. So as you are thinking about the development and as you're thinking about abatement, you're going to sort of approve, and Felix, you had mentioned there are some abatements that have been approved for a longer duration and kind of looking through that. But let's just say that it's 10 years. You're going to be foregoing that revenue for a certain amount of time. Now, if you looked through the application and really sort of digested it, and you've determined that, but for that assistance, that the project is not going to be moving forward, it's not a giving up of tax revenue because that project wouldn't be completed if there wasn't that assistance. So again, it's that foregoing of tax revenue. It is certainly a negative because again, you're seeing that development revenue come in, and then you're also seeing that levy go up. But it's not a giving up of tax revenue. It's not a negative. It is possible, of course, that during that abatement period that you may see, if you weren't to provide that abatement, that another project would come along for that same site, and they may not seek abatement assistance or any assistance for that matter. So unfortunately, none of us have that crystal ball at our disposal, but it certainly is a possibility that something else could happen during that term. And then unanticipated pressure on service levels without that tax revenue offset. Can't think of a solid example here because I haven't seen it happen. When you get those applications, you're starting to think about, okay, if we have 200 additional housing units, does that mean that we need an additional sheriff's deputy? Are we going to need additional county staff to support that? You're thinking about those things up front. That being said, it is certainly possible that something would happen as a result of a large development where you may see service levels either need to increase or new services introduced as a result of it. Haven't seen it happen yet, but possibility.
Just to add to that, that's what she outlined there is kind of why we've, I don't want to say steered away, I don't think we've had a lot of applications, but at the county level, housing, assisted living facilities, things like that that carry significant burdens on taxpayers due to the HHS component. So that's why those are the type of projects where the impact on taxpayers could potentially be felt if we offset that tax revenue. So usually we're looking at, commercial and industrial stuff, which generally contributes more to the tax base and the economy than it takes away in service.
Before we move on to some of the policy comparisons, any questions about how tax abatement works, the authority, levies? Okay, so we looked at Benton, Stearns, and Wright and compared them with Sherburne's policy. Really just kind of kept it to the neighboring communities. But these next few slides just kind of have some of the highlights from what we found in those policies. So with Benton County, I would say that their policy was likely sort of the simplest. The last bullet point here, it mentions that it generally follows state guidelines. Most of Statute 469 is actually in their policy. Their duration limitation is 10 years. They will go up to 15 if other jurisdictions choose not to participate. Difference between abatement and TIF is that when a jurisdiction is considering TIF, whether that's the county or the city, when that district is established, it automatically captures the county's portion of taxes, the school districts, and the cities. So it's one fell swoop. With abatement, each jurisdiction has, or doesn't have, they need to act independently. So in this case, what Benton is saying is if other jurisdictions are not participating, or if one doesn't participate, that they're willing to entertain a longer duration here. Other than that, the only real notable piece from Benton's policy is that while they don't have a scoring system built into their actual policy, it's built into their application. So it does suggest that they are scoring projects and determining what level of abatement they're going to provide. Okay. Stearns, very similar duration here, so 10 years, they'll do 15 if other jurisdictions are not involved. Interesting piece for Stearns is that they state that tax increment financing should be sort of the first line of defense in providing that financial assistance. This is speculation, but my assumption here is just that they don't want it to only be just the county that's participating, again, with tax increment because it captures the local taxes as well, that they would like to see that be the first option. It could also be that their position is that those specific projects that are identified in TIF law are the types of projects that they want to support. So again, redevelopment, industrial type projects, etc. Stearns limits their total abatement to 2% of the county's levy. And this is a very conservative approach. As we talked about before, state law allows you to go up to 10% of your tax capacity. So by limiting this and tying it to the levy, this is quite a bit more conservative than what you're allowed to do, being that oftentimes the levy is going to be much less than the total tax capacity. But just a conservative approach here. When it comes to housing, their policy states that they will consider abatement for affordable housing projects. Now, the wording is interesting to me because it says they may consider abatement for affordable. It does not say they will only consider, which, it's just sort of a play on words. I can tell you that in working through market rate projects in Stearns County, when you talk to their staff, if you're talking or floating past the idea of market rate, they'll tell you they're not interested in talking about it. It's just affordable that they may consider abatement for. So that is their interpretation of how that's written.
Quick point of clarification for those that don't know too. So the significance of the 10 and 15 years in these policies is state statute allows for 15 and up to 20. So 15 if everybody participates, school district, county, city. If one of those doesn't, then you can go up to, the other jurisdictions can go up to 20. So that's a significant highlighting that they're a little less than state statute.
Okay, so then last but certainly not least, Sherburne and Wright. So these are combined here just because the policies are so similar. Both use a scoring system. It's the same scoring system. Both counties limit the total approved abatements to 3% of net tax capacity, which is, again, is less than that 10% limitation. The Wright County policy mentions that it will consider tax abatement for projects with a total value of $20 million or greater. And we talked about this at the workshop, and Commissioner Dolan, you had pointed out, the note here states that the policy is not specific as to whether it's the resulting market value or if it's the project cost. And I think that what you had mentioned is it's the project cost.
Yeah, in practice, it's been total project cost.
And the reason that that's important is because we know that when projects are being built, the resulting assessed value does not always equal what the construction cost was or what the total project cost. If you've got a lot of equipment, et cetera, that's not going to translate to property tax value. But generally speaking, just the mention that it's 20 million, whether that's market value, whether that's project cost, they're looking at supporting projects only that are more regional or countywide. They're not looking to support, a small retail shop or something like that. This is meant to be something, again, if there's a lot of equipment, for example, likely you're going to have a lot of jobs coming in. So I think that's what they're trying to get at here, is that if they are going to be using abatement and having that levy spread on the entirety of the county, that it's got to be sort of a county-wide project that way. And then the last bullet here is just that both of those county policies, and I think this is really smart to have in there, limit the issuance of bonds, tax abatement bonds, to the funding of public infrastructure. So from time to time, we do see projects where a developer or development may require new streets or roads to be built, sewer lines to be run, et cetera. And those costs are quite large, so they may request that jurisdiction issue bonds up front to provide that cash. But again, I like seeing this in here because lending the county's general obligation pledge, if something were to happen with that development, if that property owner wasn't to pay their taxes, et cetera, at least from that perspective, the county would have that infrastructure. You're not necessarily supporting the building or the construction of that building. I think that is our, just some closing comments. Those policies, as you can see, they vary by community, and they'll change over time. So depending on what that community is trying to support, whether you're focusing on the commercial side of things, maybe you're trying to support and incentivize housing, those policies will evolve. But just generally, tax abatement is a flexible tool, as we mentioned. It works in a lot of different cases where, TIF or other tools may not allow for those projects to be eligible. But it is a limited resource, not a huge concern for a county. But that being said, we still do encourage our clients to look at those applications in a way that is is this support necessary for the project? We want to use this resource wisely. And that is it. So I'm happy to answer any questions that anyone has or talk about any specific project questions that may be lingering from, approvals that have happened in the past or anything like that.
Well, thank you, Jessica. Very good presentation. And yeah, if we could get a copy of that PowerPoint, that would be very helpful. Any questions for Jessica?
Just if I could, clarification. When Sherburne County first started doing tax abatements, one of the reasons that we looked at and were interested in was the ability to leave the school districts out. And I don't know if that's still the, that's something that we should talk about as we go forward. But that was part of the reason to try to hold them harmless with some of the projects that we were doing.
To Felix's point, thinking back on the projects that we've done as in the county, and there are specifically manufacturing projects and things like that where we know that there has been going to be a substantial inflow of students into that school district. It has been one of the driving reasons why we've steered projects towards abatement versus TIF. It ends up with generally it ends up with a longer abatement term to make the same amount of money available. So that's why you see some of these longer 15-year terms, because if it was TIF, it would be a 9-year term, but you'd have the school district participating too. So from day one, those projects are able to maintain the school district funds and shift that burden onto the other two entities. There's definitely, I think in practice we've done it a lot, but I don't think there's anything outlined in policy.
There's nothing in policy,
Yeah.
and that's where it got its seed. That's where we kind of started, was we wanted to hold schools harmless on some of the projects we were doing. And I think, that's a historical perspective from an old man, but I mean, that's maybe something we should be talking about a little bit again and make sure that the board still feels that way, and because we have not revisited it at all, so.
Yeah.
Just a topic for some point.
Yeah, so Dan, I see you really don't have on the agenda today going into a full-fledged discussion or analysis of the tax abatement. So am I correct assuming that you wanted to get through Jessica's presentation, let us digest that information, and then this will come back around in some form, either agenda or task force, to further this discussion?
Correct, yeah. We've met as a committee to go through the tax abatement, but I thought it would be helpful for the entire group to know a little bit more about it, and we can make decisions as we go forward. But yeah, today was just a presentation for education purposes.
Very good. All right, do we have any other questions for Jessica? All right, well, thank you again.
Thank you.
All right, that brings us to number 15, motion to adjourn.
So moved.
Motion second, all in favor?
Aye.
See you, Daniel.